Coca-Cola versus the IRS, the $20 billion tax warning. Every CEO needs to hear a company with 64 consecutive years of dividend increases, a presence in more than 200 countries, one of the most recognized brands on the planet, and today, a potential $20 billion tax problem. This week, Coca-Cola is back in court fighting the IRS over a tax dispute that traces back to returns filed nearly 2 decades ago. Most business owners hear that and think, that's a big company problem. It's not, because this isn't really a tax story. It's a leadership story, and the lesson applies whether your business generates $500,000 or $500 million. Here's what happened. Coca-Cola operates through subsidiaries around the world. Those companies use Coca-Cola's trademarks, formulas, and intellectual property to manufacture and sell products in their markets. Because they use intellectual property owned by the parent company, they pay royalties. The amount paid and how profits are allocated between countries falls under rules known as transfer pricing. The IRS audited Coca-Cola's returns from 2007 through 2009 and concluded that the foreign affiliates were not paying enough for the use of the company's intellectual property. As a result, the IRS reallocated more than $9 billion of income back to the United States. Coca-Cola's defense was simple. They argued that they were using a methodology the IRS had already accepted years earlier as part of a previous settlement. In other words, we followed the rules you approved. The tax court disagreed twice. By 2024, Coca-Cola owed approximately $2.7 billion in additional tax for those years alone. With interest, the amount exceeded $6 billion. And if the company loses its appeal, total exposure could exceed $20 billion once later tax years are considered. Now, here's the part that matters to every business owner. Coca-Cola didn't get into trouble because they ignored the rules. They got into trouble because a strategy that once worked was later challenged under a different environment. That's the leadership lesson. I work with CEOs every day who are operating with financial structures built for a business that no longer exists. The tax strategy made sense when revenue was $500,000. The entity structure made sense before multiple revenue streams. The compensation plan made sense before the team doubled. The strategy wasn't wrong. It was never revisited. Businesses evolve, markets evolve, tax laws evolve. But many leaders continue operating from assumptions created years ago. That's where risk begins. So let me give you 3 questions every CEO should ask. First, what financial strategies in my business were built for a previous stage of growth? Think about your tax structure, compensation model, entity design, and profit allocation process. When were they last reviewed? Not filed, reviewed. Second, what do I assume is already handled that I've never actually verified? Many leaders say, my accountant handles that. Maybe, but assumption is not strategy. Verification is. The strongest businesses operate on clarity, not assumptions. Third, who is watching the long tail? The IRS didn't challenge Coca-Cola's strategy when it was created. The challenge came years later under different leadership, different regulations, and different priorities. The biggest financial risks are rarely the decisions that feel dangerous. They're the decisions that feel routine. That's why financial clarity is not a one-time event. It's an ongoing leadership practice. The best leaders don't just understand their numbers, they use their numbers to protect profit, to reduce unnecessary taxes, to strengthen cash flow, and to identify risks before those risks become expensive problems. So as this case unfolds, don't just watch Coca-Cola. Use it as a mirror. Ask yourself, what assumptions am I making? What strategies haven't been reviewed? What risks am I not seeing? Because the difference between a financial strategy and a financial liability is often time. If you found this valuable, subscribe to the channel and hit the notification bell. Every week, I share insights that help CEOs and business owners increase profitability, strengthen cash flow, reduce unnecessary taxes, and make better financial decisions. And if this story has you thinking about your own financial structure, don't ignore that instinct. The link to work with me is in the description below. I'll see you in the next video.